We are back at it just in time for the world to fall apart. It was a disastrous day in the markets on Friday. We'll talk a little bit about what happened at Jackson Hole and some of the words that came out of Jerome Powell's mouth that led to just the absolute obliteration of the markets. We'll talk a little bit about where we go from here and what we could expect from the Federal Reserve in terms of where they are going with the interest rate. So stay tuned for that. But if this is your first time here, my name's Nick. Welcome to Ways to Wealth. Before we get into the video, huge favor, huge ask. If you learn something new or you get some value out of the video, do me a huge favor. Hit that like button. I definitely appreciate that. And if you like content similar to this, hit that subscribe button. Turn that notification bell on. We release a new video every single Sunday. So come back to the channel and come check that out. We will start off by talking a little bit about what Jackson Hole is. It's a conference where the Federal Reserve gets together every single year since 1982. And they talk about what the economy looks like, what the Federal Reserve is going to do. And it's the first time ever it was live stream. The quality wasn't really the best, but we got to hear live from Jerome's mouth what they had talked about, and it seemed like it was a shift in what we had previously been hearing in the past. So we're going to start off by doing a little bit of a breakdown of what Jerome spoke about and kind of the key points that I got out of the speech. So we'll jump over into the BNN article here, and we could see that the number one priority of the Federal Reserve is to get inflation under control. It's similar to what we're seeing in the Bank of Canada. Inflation is the number one target. The way that they are doing this is by raising the interest rate. They're making money more expensive, harder to get. So restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into a better balance. Restoring price stability will require a sustained period of below trend growth and a weaker labor market, Powell said. While higher interest rates, slower growth, and a softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. So what has changed about this statement that we heard from Powell on Friday? Well, originally, if you think a few months back to January or even late last year, it was the fact that inflation was transitory. It was only going to be with us for a short period of time. We kept hearing this rhetoric, everything is going to be okay. Well, in the past couple months, we've started to hear this, topic of conversation change to what is the difference between a soft landing and a hard landing. And we've covered this in videos before. So if you're not familiar with that, go check out my video where we covered if the Fed could do a soft landing. But we'll paraphrase it really quickly. A soft landing was that the Federal Reserve could use the tools that they have, whether that's to stop printing money and to bring interest rates higher. And what they would do is they would try and mitigate the minefield to prevent as much damage as possible. This was basically preventing as hard of a recession. We fast forward a few weeks after we've seen 75 basis point hikes in the last two, we're starting to see Powell introduce the fear of a recession, introduce it into the conversation so that all of a sudden, when we fast forward to the next meeting, when the numbers have not improved, it's kind of like he's introducing or kind of planting the seed, softening the blow. This is the first time I've really seen the Federal Reserve come out and say that we are going to experience pain. And the reason that we're doing this is to curb inflation. Now, there's obviously a lot of different topics and a lot of different research you can find out there where a lot of people think that the Federal Reserve actually cannot curb inflation by using the monetary tools. You'll have to look at supply and some of the other issues in which we have covered in the past. But the fact of the matter is, the one that I see and the one that I kind of align with is that commodity prices are still high. especially when you look at oil and how important oil is for the economy in the short run. You're at over $90 a barrel US for crude. So it's still going to be higher pressure, maybe not the prices that we saw before at the pumps, but still playing into a lot of different things, even if you look at diesel, for example. But realistically, the most important question is where do we see ourselves going? Where does the Federal Reserve see the interest rate going? So we fast forward to get a little bit of an opinion from this article here, and we see Fed officials in June projected rates rising to 3.4% by the end of this year and 3.8% by the end of 2023. So they will update these forecasts in September. Powell was a little bit hesitant to give guidance as to where they could go because they're still waiting for some data points to come in. Now, in the last print that we saw for CPI or for inflation, we actually saw it coming down a bit. So a lot of people are projecting that inflation has peaked. We can go back and take a look at some data points from Michael Burry. He actually came out and stated that inflation goes through peaks and troughs. And although we have kind of peaked now, there could be a potential that we do see higher highs when it comes to inflation. And that is something that obviously we will take offline for this video. We're more concerned about where we could go, but something that we could definitely touch on in the future. So investors are pricing in the probability of cuts in the back half of 2023, though officials are starting to push back against that view. Now, we've covered this in a video before. Anytime that CPI has passed over that 5% threshold, the Federal Reserve had to raise the interest rates to the equivalent number of inflation in order to bring it down. That would mean that if we're at 6 or 7% right now for inflation, that means that the interest rate will have to be 6 or 7% in order to cut inflation off at the leg. So that is, a potential theory as to how far we could get on the spectrum. But, the fact that the market is pricing in 2023 cuts, they're almost insane. Let's take a look at BMO. They also have their own thoughts as to where the market could go. And we see here that the projection is that they lean towards a lesser 50 basis point hike on September 21st. That's the next meeting. The next set of job and inflation numbers could ultimately decide the outcome. We see rates headed to 3.5 to 3.75 at year end, a full 125 basis points above the current level. And we don't expect them to fall until beginning of early 2024. Obviously, these are projections. These are what the analysts are seeing. We don't know what this is actually going to be, but we're playing the multitude of different effects. So we just had a couple weeks of, earnings reports that weren't as bad as what we were anticipating. But the underlying factor of the market right now, the underlying hindrance is the fact that inflation is still there. And it could be, on the downturn, but is there a potential for it to come back up? But we know in the short run, rates are going higher. So, realistically, the fact of the matter is, and the long story short, is that you should be expecting more pain in the short run. We're not out of it yet. There's definitely a clear path to a recession. Big question is how long recession lasts. Let me know what your thoughts are. Do you see the Federal Reserve, backtracking the rate hikes in 2023? Are we looking at more problems down the road where we could potentially be going higher? Let me know down in the comments what your thoughts are. I hope you all enjoyed the video. If you're still here with me, hit that like button. I appreciate all of your support. I hope you have a great week in the markets. Happy trading.